Josef Gunther, the Vanishing ledger. The office was above a quiet hardware store on a side street that still had street-level retail. The business itself was a small commercial cleaning company, steady contracts, modest margins, and a reputation for showing up on time. The owner, a man named Alan Ruiz, had built it over 12 years. He knew his crews. He knew his numbers, until the numbers stopped making sense. Josef Gunther listened while Ruiz laid out the problem in careful detail. Over the past 9 months, small discrepancies had grown into something harder to ignore. Cash flow was tighter than the invoices suggested. Supplier payments were occasionally late even when the bank balance should have covered them. 2 recent quarterly summaries had required quiet adjustments that Ruiz could not fully explain. He had not yet gone to an outside accountant. He wanted the truth first, and he wanted it contained. Josef took the case under the usual conditions: complete discretion, no unnecessary copies, and a preference for solving the matter without public filings if the evidence allowed. He started with the records. For 2 weeks he worked methodically. He compared bank statements against deposited checks and electronic transfers. He reconstructed the bookkeeping entries month by month. He examined the timing of adjustments and the user logs on the simple accounting software the company used. Most of the operation was clean. One pattern was not. A long-time office manager named Diane Cole had been with the company almost from the beginning. She handled invoicing, vendor payments, and the daily reconciliation. She was trusted. She was also careful, just not careful enough over time. Josef found a series of small, regular diversions, rounded-down deposits, duplicate vendor payments that went to accounts she controlled under slight variations of legitimate names, and periodic falsified expense entries that covered the gaps. The amounts were never dramatic in a single month. Over 9 months, they added up to a sum that had begun to threaten the company's stability. Josef did not confront her immediately. He built the file until it was difficult to dispute: side-by-side ledgers, matched bank trails, and a clear timeline of the falsifications. Only then did he sit down with Ruiz and walk him through every step. Ruiz's reaction was quiet and heavy. He had trusted Diane with the keys to the office and the passwords to the accounts. The betrayal was personal as much as financial. Josef arranged the next conversation carefully. Diane was asked to come in for a private meeting after hours. Ruiz was present. Josef laid out the evidence without accusation in his voice, only the facts, ordered and clear. He gave her a choice that protected the company: full written admission, a signed repayment agreement, and immediate resignation. In return, Ruiz would not pursue criminal charges or a public civil action, provided the agreement was honored and the remaining shortfall was addressed on a realistic schedule. Diane signed. She cleared her desk that night. Josef oversaw the immediate practical steps: password changes, a clean external review of the books going forward, and a quiet notification to the bank that certain linked accounts should be monitored. No press, no police report, no drama that would have reached clients or staff beyond those who needed to know. Within a month, the company's cash flow had stabilized. Ruiz hired a new office manager through a careful process and slept better than he had in the better part of a year. Josef declined any offer of ongoing retainers. He accepted the agreed fee and a firm handshake. The ledger was clean again. The privacy of the business had been preserved. The matter had been closed without a public scar. He left the office above the hardware store and walked out into the evening. Another quiet theft undone by patience and paper. That was the work. That was enough.